In this video, we're now going to look at how to make adjusting entries. Since we now have an unadjusted trial balance, there are some year-end adjustments we normally need to make, and we'll look at a problem here that will demonstrate that for us. Okay, we have our question here. It tells us the ASME Wholesale Food Company's fiscal year end is June 30th. The company issues quarterly financial statements requiring the company to prepare adjusting entries at the end of each quarter. Assuming all quarterly adjusting entries were properly recorded, prepare the necessary year-end adjusting entries at the end of June 30th, year 2 for the following situations. So we have 5 adjusting entries we'll be making, and you can go ahead and read them on this screen, and I'll have them separately on the following screens. Our first transaction, on December 1st, year 1, the company paid its annual fire insurance premium of $8,000 for the year beginning December 1st. Okay, so being that we are recording for year 2, obviously since they paid this insurance premium of $8,000 in year 1, it was a prepayment. So what we're doing quarterly is recognizing that prepayment. So we're turning it into an expense. So to look at that, if you remember from the first part when I read the problem, it said they're making quarterly financial statements. So they make one at the end here at March 31st. They make one June 30th, make one September 30th, and then December 31st. And each time they are recording the adjusting entries to decrease their prepaid expense account. So all we simply have to do to figure out how much to record for this quarter ending June 30th is take the total of $8,000 and multiply it by 3 out of 12, 3 months out of the 12 months in the year, or a quarter of the year, which gives us 2,000. So that tells us that our journal entry then at June 30th is insurance expense for $2,000. And then we will credit prepaid insurance because that's what would have been debited because they paid cash in year 1. So now we're decreasing the prepaid insurance account as we recognize the expense. Okay, our second transaction. On August 31st, year 1, the company borrowed $88,000 from a local bank. The note requires principal and interest at 9% to be paid on August 31st, year 2. So this is fairly simple. Again, what we're doing is we're making adjusting entries for each quarter. So simply we need to figure out what the total interest is and then multiply that by 3 months out of the 12 months in a year, and that will tell us what our adjusting entry is. So here we start with the $88,000, and this is our principal. We multiply that by the 9% interest rate. So it tells us what our yearly interest is. And then if we multiply it by a quarter of the year, 3 out of 12 months, that will tell us what our adjusting entry is. So 88,000 times 9% times 3 over 12 is $1,980. So we will recognize that as interest expense. For $1,980. It doesn't say that we are paying cash at this point because it's due August 31st, so we'll assume it's an interest payable, and we'll credit that for the same amount. Our third transaction, ASME owns a warehouse that rents to another company. On January 1st, year 2, ASME collected $25,000 representing rent for the year 2 calendar year. So this $25,000 collected at the beginning of year 2 is deferred rent revenue because we haven't earned it for the year yet, so we'll be recognizing it quarterly. So let's do that entry on January 1st down here just to give us an idea. So that would have been cash for $25,000 for the cash we collected, and then we would have credited deferred rent revenue because we haven't earned it yet. So if we haven't earned revenue, it goes into a deferred or unearned account for $25,000. So then quarterly will decrease this deferred revenue account as we recognize revenue. So again, all we have to do for this quarter, June 30th, we just take the $25,000 and multiply it by a quarter of a year so we know what to recognize for this quarter ending June 30th. So if we multiply that out, that will give us $6,250. So we will decrease with a debit the deferred rent revenue account for this amount of $6,250. And then we will now recognize revenue with the rent revenue account, $6,250. Okay, our fourth transaction. Depreciation on the office building is $16,000 for the fiscal year. So again, this is going to be very simple. Again, we're reporting the financial statements rather quarterly. So all we need to do is take that $16,000 and multiply it by a quarter. And that's going to give us $4,000 that we'll recognize for this quarter as depreciation expense. So we have depreciation expense, $4,000. And then, of course, the credit is accumulated depreciation. And we'll put building so we know what it's going to. $4,000. Our final transaction tells us the employee salaries and wages for the month of June, year 2, of $20,000 will be paid on July 20th, year 2. So this $20,000 needs to be recognized in the quarter ending June 30th because they owe these salaries and wages, but they won't be paid till July 20th. So to look down here at my timeline, this is the quarter the expenses have been incurred, so we need to recognize them here, but they won't be paid until here. So that means for the quarter ending June 30th, we need to use a salaries and wages payable account rather than cash for our journal entry. So you'll see what that looks like here. So we're going to recognize the expense, salaries and wages payable, or salaries and wages expense. And it's going to be for the $20,000. And then rather than decreasing cash, we're going to have a payables account until it's paid off at July 20th. That'll be for $20,000.